Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of the Chicago soybean complex.
Chicago soybeans. 20 weeks ago, I said here and at every opportunity since, and I quote, "The only other thing to bear in mind is not here on this daily chart, but in Chicago soybean meal." And that is the well-highlighted annual key reversal down we saw here for 2023. Not directly related here, but not worth ignoring either, end of quote. I feel I must keep repeating this point, that in all things this year and going forward should be seen in the shadow of this pattern. Okay, so from the May double top, we have seen prices head lower at the start of June and thereafter. The primary and secondary targets were achieved. The next feature is one I drew and spoke about 10 weeks ago, and I quote, "I've drawn a new, small, recent, bright red highlighted bearish Andrews pitchfork for the action during May. It is a nascent pitchfork, but I have decided to place it in anticipation of a possible move lower," end of quote. Well, until recently, I had really nothing to add or to do to this pattern. It was not perfect, but it worked well until the changeover gap, and I'm still minded to keep it on to help show the bearish angle of attack. We are right now below the lower time, currently at 998. It's just interesting to know how the changeover gap happened right at the 61.8% absolute Fibonacci line at 1106. I spoke about this 7 weeks ago, and when I said, and I quote, "Below, we really only have the 61.8% absolute Fibonacci in the way at 1106 before we test down to November 2020 low at 1045. That is something to ponder upon," end of quote. The move lower was quite swift and continues this week, reaching down to the September 2020 low at 942 and the dark blue optimized extension to the February to October 2021 head and shoulders top. That's currently at 942 also. Overhead, what we had previously had as 3 bands of static support, well, they have now become resistances. The first was the previously mentioned 1045 level, then a congestion between 1031 to 1033, and then the October 2020 low at 1017. 2 weeks ago, and again last week, we saw penetration and now a break below all of these levels and stabilization below all of them. Looking below, we have, as recently as yesterday, been testing the congestion base around the September 2020 low and a dark blue neckline extension. So far it's held up. However, much like my comments from last week, and I quote, "I'm not sure how good a support even that would be given the overhead ammunition pressing down on the market." These actions also have highlighted that the January to May action was a form of halfway hesitation, with the origin of this bearish halfway hesitation starting back in late November last year, and the potential for a move lower is down in the 980 zone, not very far away, end of quote. Well, prices have reached and exceeded the 980 zone, seemingly temporarily pulling up today, but it would be wise to look at better supports below. Hence last week I said, and I quote, "Looking even low, we do start to see some longer term supports enter the frame in the 895 to 910 zone, but that's quite a way lower. I'll discuss these more fully should we start approaching them," end of quote. All these comments still stand. Chicago soybean meal. Back in late February this year, down at 326.90, the market consolidated after a significant fall that developed from the middle of November last year. This congestion was different compared to earlier ones, as we had crossing through it back then the dark blue highlighted extension to the lower trend line, currently at 324 even, of the July to September 2021 descending triangle. I said 22 weeks ago, and I quote, This may be nothing, but I'm minded after such a fall as we've seen last November last year that this just may see some hesitation around the 327 to 325 zone. I'm not certain on that, but it's worth considering. End of quote. Well, prices utilized this dark blue highlighted extension into descending triangle as a base back then and rallied back up, eventually ending up being capped with a double top formed over the month of May. And with the additional help of the declining long moving average at the time, which is currently at 361.40, and the 50% Fibonacci line of the August 2020 to March 22 move at 390 even. The construction of this double top inevitably led to a move lower, down through the primary and secondary targets, but the key break lower happened at the third attempt, pushing down below the flatlining medium moving average, which is currently at 345.60 in early to mid-July. Last week we finally saw prices rise enough to fill in the significant changeover gap between 335.90 to 319.5. However, this pullback higher has not been sustained, at least not so far, over the dark blue trendline extension. We're now back down below not only this, but also down to levels not seen in August, so not seen since last August and September 2020. Last week I put forward a couple of features. The first was the bright red bearish Andrews pitchfork for the action between early July until last week. It has developed this week such that it helps in showing the bearish angle of attack. The second is even more recent and was for a potential weekly key reversal down for last week. This came about and we have seen a follow-on lower to even weaker prices this week. This now leaves me wondering, what next? Well, the drop this week was halted and turned up yesterday, unsurprisingly, by the band of congestion detailed on my daily chart between 282 even to 300, dating from April to August 2020. This doesn't mean it's the end of the decline, just the end of the current phase. This prompted me to this week draw a mid-November 2023 to early May 2024 bearish shift pitchfork. And I'm going to see that the lows of this week are also testing the middle time, so, which is currently at 370, much as they did in mid-July. Finally, I also took a look at the bigger picture here, and I'd like to put forward the possibility that the whole mid-November to date action could be seen as a possible large bearish halfway hesitation. This would give a potential below down in the 253 even zone. In other words, down to levels last seen in 2016. I now only need to remind you of my words of 59 weeks ago and ever since, so well over a year ago, when I pointed out that the Chicago soybean meal was about to have that rarest of patterns, an annual key reversal down. This duly came about at the end of 2023, and we've been living in the shadow of this pattern ever since. All these things are worth pondering and considering. Chicago soybean oil. The market's drift of sideways to lower this year has been down through various congestion bands. These are 44.68 to 45.04, made up of the 2014 high at 45.04 and the May 2023 low at 44.68. Then the tight 43.80 to 43.94 zone, made up of the 50% absolute Fibonacci line at 43.80 and the April 2014 high at 43.94, with the nearby neckline extension, highlighted in bright red, of the October 2019 to February 2020 head and shoulders top, currently at 44.53. Then the interesting congestion down at about 42.65, plus more recently congestion at 41.15 and the January 2021 low at 40.53. So there's a lot to take in there. Please replay if you need it. Prices are now looking down at the November 2020 high at 39.04 before a gap down to the December 2020 low down at 36.56. I mention all these because some 57 weeks ago and numerous times since I said the following about a big descending wedge pattern that was on my daily chart back then and is now high up off the top of my chart. I said the following when I quote, "I would consider this descending wedge pattern may have lately morphed into a possible scallop pattern." End of quote. So this was a big pattern idea, and the market's decline since autumn of last year fitted in with this, with the expectations I voiced of eventually witnessing a fall down to the area of the May and June lows between 48 to 46 zone, which is where we've been until recently. I've often stated here how I was keeping a very, very close eye on this idea, as any significant break below the 48 to 46 zone could signal the start of the rest of this move lower. 3 weeks ago, prices finally punched down through the bright red neckline extension and at the same time started a definitive move lower below the previously mentioned 48 to 46 zone. It seems the market has come to a cusp and has chosen the way lower. A new early July to date pattern has emerged, a purple highlighted bear channel, currently 36.95 to 41.85. All these actions seem to have secured some significant potentials on the downside. Thus, for the original big, early, much earlier mentioned 57-week-old big descending wedge pattern, we have the following opportunities on the downside. A primary target X would be in the 33.70 zone, with a secondary, much harder to reach target X1, down in the 16.25 zone. Even a cursory examination of these two targets and one can deduce some notable points. The primary target down at 33.7 is just above the 50% absolute Fibonacci line at 33.45 and is doable, especially with the addition of the monthly key reversal down we saw in July. The secondary target at 16.45 is so far down that calling it harder is a massive understatement. We would have to be down to levels not seen since May 2002, and I would think achieving that is a monumental task, and one right now that is in all truth I could not endorse.
Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Service International Limited. And here comes the final important bit.